Hello everybody and welcome to MD's Options Trading. In this video, I am going to explain you about calendar spread strategy, the positional one. In last two videos, I had explained you how calendar spread can be implemented on the day of expiry, especially whenever how to deploy the calendar spread whenever your view is bearish or sideways, and how to deploy the calendar spread whenever your view is slightly bullish and sideways. In this video, I am going to explain you the calendar spread for the positional strategy, which is completely non-directional. So you can see my trade running. For my followers, I have deployed this kind of demo trade with the one lot on 2nd of September. If you check here on 2nd of September, this is the date. On 2nd of September, Nifty was trading around 25,250. This was the level of Nifty. Nifty was trading around 25,250. So I'll explain you over here. It will be the better thing what I did. When it was around 25,250 on 2nd of September, I sold 25,500 call. This negative, that means I sold, and I sold this 25,000 put. Negative, that means I sold. I did this in October series. This also I did in October series. And at the same time, this for the same strike price, that is 25,500 call, I bought, and 25,000 put I bought, and this I did in November series. This buying, and this also I did in November series. So what I did, I placed one triangle. When this was the spot, I can write it down over here. When this was the spot, around 250 points down, I sold one put. 250 points up, I sold one call. This I did in the month of October, and for November, I bought the hedges for this same strike price. Now a common question which should come in your mind, like if it was on 2nd of September, then why I deployed the calendar for October and November, and why I did not deploy it for the September and October? It's a common question. It was on 2nd of September. So I could have done for September and October, but why I did for October and November? So this is very much tricky question or tricky part. Just focus here. I will explain you the logic. Now if you see here about my trade, you observe carefully. The date of October expiry, it was on 31st of October. What was the date? It was on 31st of October. I'll write here so that you will understand. The deployment date was on 2nd September, and September expiry, it was on, I guess, 26th of September, and October expiry, it was on 31st of October. Here is the clue. See, if you can see how many days were remaining. I deployed it on 2nd of September. The expiry of September, it was on 26th of September. So 24 days were remaining. I will write it down over here. Remaining days. Days remaining. 24. This was on 31st of October, expiry of October. And the deployment was the 2nd of September. So the days remaining were around 31 days of October and around 29 days of September. So you can say around 60 days. And here is the basic mathematics. The rule which I follow and which works fantastically, what I do, I multiply this number. I multiply this number by 2. I multiply this number by 2. So this is 24 multiplied by 2, which is 48. And this number has to be greater than this number. Try to listen it carefully. So for the expiry for which I am going to sell the strike price now. So how many days are remaining? I multiply these days by 2. And then that number has to be more than this number, the days remaining for the hedges. So here in this case 24 by 2 is 48. 48 is not more than 60. So I did not deploy for September. Had it been, for example, had it been the September expiry on 30th of September. Okay, just focus here because this is very much important concept. Had it been the September will be on 30th of September. So how many days were remaining? Remaining days could have been 29 days. And October could have been the 24th of October. So how many days were remaining? The 24 plus 28, you can say around 53 or 54 days remaining. So 29 multiplied by 2, which is 58, which is greater than 53. 58 is greater than 53. So in that case, I would have deployed it for September and October. But as the September expiry was bit earlier and the October expiry was bit, you can say late, I prefer to sell it for October and November. Now what is the reason behind this? The reason is about the gamma impact. Let's say for example, if I had deployed it for September and October, for less number of days were there for September and higher number of days were there for October, and if the market would have fallen down drastically, then the gamma impact would have been more. So what is gamma, what is delta? I have created a complete series on option Greeks because option Greek is very much important topic in order to understand the calendar spread. I created the entire series for that. You can watch the series on the option Greek. But if I had done it for September and October, and if market would have fallen drastically, let's say 500 or 600 points, then the gamma impact would have been more. And the same thing happened. You can check here in the chart. After my deployment, market fell drastically by 450 points. And then it recovered by 800 points. So you can see how much the market it was volatile. After my deployment, immediately it fell down by 450 points and recovered by 800 points. That means it was a move of around 1200 points, but still my calendar spread, it was rock solid. It was not affected by these kind of movements and I am sitting in a profit. Now when the market was crossing 25,500, here I exited from my put leg in a profit of close to 400 rupees, and then I deployed new put at the money, that is 25,500. So what I did earlier, my payoff graph was like this because it was a kind of triangle. Now I have converted to this like the straddle. Now what is straddle calendar, what is triangle calendar, I cannot cover in a small video. You can see the payoff graph. Now this is a typical straddle. Earlier it was like this, this and this. So slowly depending upon the market conditions, now what I did, I converted my triangle to straddle. This is how it is working. And remember, in any day I have not spent more than 5 minutes for my trade, and that is what my USP is. I do not give more than 5 minutes in a day. And if you see what my current MTM is going on, that is close to 1100. So 1100 is the MTM going on, and the capital deployed for one lot of calendar spread is not more than 45,000. So even if you consider the 45,000, it will be 45,000 multiplied by 100, which is close to 2.44%. 2.44% in how many days? Today is the 20th of September. I deployed on 2nd of September. So in 19 days, I got 2.44%. If you convert it on monthly basis, so I multiply it by 30 and divided by 19, which is close to around 3.85%. You can say almost close to 4%. And without just one adjustment, which I did it today, and without spending more than 5 minutes in a day. And what was the clue behind that? Clue behind that was the deployment. Thus, one statement is that the well-being is the half done. I could identify that the September and October may not work well. Rather, October and November will work well with the help of my formula, and with that I am sitting with a fantastic profit. Now, what are the adjustments of calendar spread? What is straddle? What is triangle? What one needs to do when the market is going up or market is going down? All the things I cannot cover in a small video. I arranged a free webinar or workshop on 26th of September 26th of September 24. It's a Thursday at 7:30 p.m. in which I'm going to talk about equity investment, gold investment, and options trading. And in case of options trading, my expertise in expiry trading, I trade the expiries, and also I trade the calendar spread in positional strategy. All these things I'm going to cover in my workshop. So link of the workshop is in the description. It is going to be a complete free webinar for all the option traders and investors. I'm going to invite you for that workshop. Kindly attend my workshop and see you inside. So thank you and have a nice time. Thank you.